Ladies and gentlemen, welcome. This is again our seminar 4ST441, Statistical Methods and Capital Markets. And the number of today's seminar is 11. I showed you a lot of things, a lot of issues for the really basic analysis of the prices, stock prices and long returns, etc. Because this is our basic course on the bachelor degree. Yes, so I showed you only some basic issues, and because on the previous seminar I talked to you about your semestral thesis and the semestral paper, today we will start with talking about other issues, maybe a little bit more sophisticated, but the issues which were not required, yes, which will not be required for your final evaluation. Yes. Today we will speak about technical analysis of stock prices. Yes, consists of many of techniques. Yes, in the past I showed to you only as I already said, the basic models, basic evaluation of correlation structure in the time series, yes, and the basic methodology for the analysis. So it's possible, yes, to learn a lot of other techniques. It's used to predict the future direction of the stock price. Yes. If you remember, when I showed to you models where I tried on the basis of the correlation structure, yes, and other information, where I tried to find a forecast, a model suitable for the forecasting, yes, of the time series. You could see that it was very complicated. We were able to predict 1, 2, 3 values, yes, to the future, but with a wide confidence interval because of significant volatility in the time series, yes, and other things, yes. So it's complicated. The idea beyond technical analysis is the hope that historical price patterns will appear in the future. It's necessary to study, yes, the historical development of the time series, because many times, yes, occur that some development in the past, yes, can be repeated in the future, repeated almost in the same way or in the similar way, yes. So it's possible, yes. Identifying these patterns in early stages can thus help us to foresee future movements in the stock prices, yes. This is connected with the information which I said in the previous sentence, yes. Okay. Technical indicator is a specific function of past prices. Yes, technical indicator, specific function of the past prices. Yes, the evaluation, observation of the past prices, trading volumes, etc. Yes, we distinguish between price based or volume based. Yes, price based or volume-based technical indicators and combined price volume-based indicators. Yes. Technical indicators may be used to generate the so-called trading signals or the rules, yes, signals or rules which tell us when to buy, sell or hold our assets or stocks or papers, etc. Yes, so everything. So this is very, very important, but you must know, it's very important that you must know that the theory is one thing, but in the real life, yes, outside in the real economy, yes, you can follow these rules, you can follow these practice, and the future development of everything can be absolutely different than you expect, yes? We know that in many percent, yes, of observation, in many percent of cases, if something happens, we can expect this way, yes? Yes, we have these rules, but the world outside is very, very dynamic, and we can use these rules, but we must know that the future can be different, yes, because of some uncertainty, yes, of these rules. Okay, so we'll continue. Trading signals, yes, may be used to decide about our trading strategies. Maybe, yes, may be used to see whether trading strategies based on trading signals are superior to standard strategies such as buy and hold. We have to evaluate their performance. Yes. We will speak about uptrend and downtrend. Yes. So please remember these two words: uptrend and downtrend. Uptrend is the situation when every next local maximum is higher than the previous local maximum. Yes, you already checked some chart, yes, some graph of the development, yes, of stock prices or any prices of any portfolio. Yes, so you can imagine what's an uptrend. Yes. Downtrend. Downtrend is the situation when every next local minimum is lower than the previous local minimum. Yes. So uptrend and downtrend. Yes. Okay. Structure of the lecture. Yes. So because we know this uptrend and downtrend, we'll speak about structure of the lecture. So it's necessary to define, yes, define the technical indicators. Yes? So the definition of technical indicators, trading signals or trading rules will be discussed. Yes, trading signals rules which can be used to accomplish a trading strategy, yes, and measures of the performance of trading strategies. Yes, very, very important again, which must be said to you. Yes, everything here, everything about I will talk, yes, is uncertain. Yes, so it's a theory, and it depends on you. Yes, only on you if you are able to use this and be successful, yes, in the real economy, in evaluation of real-time series, and if you win or if you lose. Yeah, this is very, very important. That this depends on every one of us. Yes. Okay, so technical indicators. Yes, technical indicators. We distinguish following technical indicators. Indicators of the direction of the trend. Yes. We talk about the modeling of trend. Yes. We talk about the long-term development of the time series. Yes. Trend. Time series can have increasing trend. Time series can have decreasing trend. Yes. Or, for example, the changing of cycles. Yes. Changing of cycles, changing the phase of increasing with the phase of decreasing, etc. Yes, trend can be exponential, trend can be logarithmical. Yes, trend has many forms which can be modeled, for example, by some simple mathematical function. Yes, we talked about the modeling of trend. So indicators of the direction of the trend. Moving averages, yes, we know what is moving averages. Moving average with the particle length, yes, the length equal to 2, 3, 4, 5, 7, 19, 20, etc. Yes, the particle length which is set on the basis of the character of the time series, on the basis of the periodicity of the time series, etc. Moving averages, yes, very important tool. MACD, moving averages, convergence, divergence, yes. Okay, indicators of the volatility, Bollinger Bands, and OHLC, open, high, low, close price. Yes, maybe you remember when I showed to you some time series of the stock prices, yes, which were downloaded from Yahoo Finance. I opened these time series, for example, in Excel or in eViews in front of you. Yes, you could see that there were more columns. Yes, more columns, and we have here open prices, the higher prices, lower prices, and the close prices, the prices at the end of the working day. Yes, so 4 columns. Yes. So, in the case of many time series of development of stock prices, we know 4 columns, 4 types of these prices: open, high, low, and close. Yes? Okay. Indicators of the speed of the price change. The speed of the price change, the dynamic of the change. Yes? Relative strength index can be denoted RSI, relative strength index, yes, or rate of change, ROC, rate of change. Yes? So this can measure the relative speed of the change, for example, in percent or in percent points. Yes. If we evaluate the ratio is interpreted in percent, yes, and the difference is interpreted in percent points. Yes. If we calculate the ratio of today price and yesterday price, yes, interpretation must be in percent, the ratio, yes? And if we calculate the difference, today price minus yesterday price, yes? The interpretation is in percent points, yes? This is very important, please remember this. Remember the difference between percent and percent points, yes? Okay, so we can start to speak about the simple moving average, yes? In the basic course of the statistic, yes? Either 4ST441 or statistic in English 2ST601, yes? I don't know which subject you studied before, but I hope that you studied statistic. You know what is it? The moving average, yes? Simple moving average SMA of the last and price values, yes? X is calculated according to the following formula. It's very important that there is the parameter and the length. Yes, the length of the moving averages. Moving averages are widely used, not only in statistic, not only in capital markets, but for example in demography. Yes, in demography, for the smoothing of some curves, demographical curves, yes, for example mortality curves, yes, etc. So we are using in many subjects, we are using different lengths of moving averages, yes, and this length, yes, is necessary for you, is important for you, because, for example, in the stock prices, yes, when we evaluate everything only in working days, yes, and you know that working week, yes, is from Monday to Friday, and we have 5 working days. So the development, yes, the development of the time series is a series of working days, 5 working days and 5 working days, etc. Yes, so it's possible to use moving average of the length 5. If we evaluate, for example, quarterly published time series, we can use moving average of length 4. We analyze monthly published time series, we can use moving average with the length 12, etc., etc. And in special situations, special analysis, for example, as I already said, for example, in demography, yes, we are using the different length and the combination of the different length of moving averages. Yes, moving average of the length 11, 19, etc. Yes, so it depends on the situation. Yes, okay, so there we have the basic formula, yes, of the calculation of moving average, trading signals, trading rules, yes. If the last price moves about the simple moving average, then buy, it means x in time t minus 1, so the previous value, is smaller or equal to simple moving average. On observation in t minus 1, yes, we are using the length n, yes. So this, and x in time t minus 1 is higher than simple moving average in time t of the particular length of the moving average. Buy, yes, this is the signal for buying. So this is first important rule, but it's only recommendation. recommendation for you. Yes, this decision depends on you. Yes, you know that this is a recommendation, and if you lose or if you win, you will see in the future. Yeah? This is only recommendation. Okay, another. If the last price moves below the moving average, then sell. It means observation, yes, x in time t minus 1 is higher or equal to simple moving average on observation t minus 1, simple moving average of the particular length n, yes, and x in time t minus 1, so the previous observation is smaller than simple moving average on time t, on the current position, yes, on the particular length. This is the signal for sell, yes, but it's a recommendation, yes. We will continue about double crossing method, yes. We have two simple moving averages, yes. You remember the previous two slides, as we talked about simple moving averages of the particular length, yes. We have two simple moving averages of the different lengths, yes, different lengths. N1 and N2, yes, where N1, short-term moving average, is smaller than N2, yes. So, for example, the length 3 is smaller than length 5, yes. Or, for example, length 5 for weekly published data with working days only, yes, 5 is smaller than 10, yes, the length 10. Okay, so N1 is smaller than N2, long-term moving average, yes. And now the rule, simple moving average, yes, on observation t minus 1 of the length N1, yes. If this simple moving average is smaller or equal to simple moving average on observation t minus 1 of the length 2, yes, so long-term moving average, and simple moving average on time t, yes, of the length N1 is higher than simple moving average on observation t of the length N2, yes, there is the signal for buy, yes. So you can write this rule, yes, to your notebook or papers, etc. Yes, and this is the signal, the recommended signal for buying. Yes. Okay. The golden cross. The golden cross occurs when a short-term moving average crosses over a major long-term moving average to the upside, the golden cross. It's interpreted by analysts and traders as signaling a definitive upward turn in a market. Yes. Basically, the short-term average trends up faster than the long-term average until they cross. Yes. Okay. We will continue with double crossing method. Yes. 3 stages to golden cross. Yes. So we have here 3 stages to golden cross. A downtrend that eventually ends as selling is depleted, exhausted. Yes. A second stage where the shorter moving average crosses up through the longer moving average. And finally, the continuing uptrend hopefully leading to higher prices. Yes, there is illustration chart. Yes, do you remember about open prices, close prices, maximum and minimum? We have here development. Yes, these points, yes, with the tubes and upper and lower lines. Yes, there is a development. There is a development of the close prices, open prices, maximum and minimum prices. Yes, and we have here some curves. Blue curve, 50-day moving average. Yes, I talked about 5 days, 10 days. We have here 50-day moving average. Yes, and the black curve, 200-day moving average. Yes, and the illustration of the golden cross is here. Yes, on this point. But remember that this rule, this another rule, is again only a recommendation. Yes, only a recommendation. Okay, we'll continue. If the last price moves below the moving average, then sell. Yes, it means again, we are using N1 smaller than N2, yes, the length 1 smaller than length 2. Simple moving average on observation T-1 of the particular length N1, yes. So this is higher or equal to simple moving average on observation T-1 of the length N2, yes. So if this is higher than this, and if simple moving average on observation T-1 of the length N1 is smaller than simple moving average on observation T of the length N2, that is a signal for sell. Yes. So you can compare this with this signal where we have a signal for buy. Yes. Now I will scroll in this presentation. This is signal for sell. Signal, the recommended signal. Yes. It's voluntary. Yes. It's not necessary to do this. Yes. You must use another information, yes, not only this information, but also another, and also your skills, yes, and etc. Okay, so this is the signal for sell. The dead cross, yes, the dead cross is constituted by downside moving average crossover. Yes, the dead cross is constituted by downside moving average crossover. It is understood to signal a decisive downturn in a market. Yes, that cross occurs when the short-term moving average, SMA, yes, trends down and crosses the long-term average. Yes. So another important sentence, that cross occurs when the short-term moving average trends down and crosses the long-term average. It is opposite direction then in the golden cross. Yes, opposite direction then in case of the golden cross. Yes. Okay, and we have here illustration. You have this presentation in front of you. Yes, I already sent this presentation to you. So we have here the development of prices. Yes, maximum, minimum prices, open prices and close prices, yes, in case of this special chart, yes, and again, the red curve and the blue curve, yes, the red curve is 50-day moving average, yes, we can use different lengths, yes. It depends on situation, on evaluation, on you, on the theory, etc. Yes. So on the previous slide, there was written N1 is smaller than N2. Yes. The length 1 is smaller than length 2. So we have here N1 equal to 50 and N2 equal to 200, yes? So, the red curve, 50-day moving average, blue curve, 200-day moving average, yes? And there is a cross. There is a cross, and this cross, opposite to the golden cross, is called the dead cross, yes? Okay. So this is illustration. We'll continue about double crossing method. Yes, a band may introduce around the moving average to avoid generating many random signals. Yes, when the moving averages are close. Yes. It's very, very important to think on many random signals. Yes, I show to you 2 or 4 rules, common rules. Yes, which are based on theory, but you are statisticians. Yes, and we know that everything is valid, for example, in only 95% of observation, yes? We are using in statistical significance level, alpha, 5%. So, we know, yes, we can expect in 95% of situations that it will be according to our expectations, but we have some space for the fail, yes, for the fail decision, the wrong decision, yes. So everything about we told here, yes, is under some uncertainty, yes. So a band may introduce around the moving average to avoid generating many random signals, yes. A bi-signal is generated if the short moving average is above the long moving average by an extent large than the width of the band, yes? So, one more time, a bi-signal is generated if the short moving average is above the long moving average by an extent larger than the width of the band, yes? There are several variations of the bands, yes? You know what is it? Lower bound and upper bound, yes? We tried to calculate, estimate, yes, some bounds. In the case, for example, forecasts, yes, we constructed 95% bounds, yes, and this is similar, yes, bounds or bands, it's the same almost, yes. There are also many variations of moving averages, yes? Weighted moving average, volume weighted moving average, and exponential moving average. It's the shortcut EMA, yes? Okay, we can continue moving average, convergence, divergence. The shortcut MACD. We already talked about this. And now we will speak more. Yes? Moving average convergence divergence, MACD, yes, is an indicator that shows the relationship between two moving averages of a stock price. Yes? The MACD, moving average convergence divergence, is calculated by subtracting the 26 period exponential moving average, AME, yes, from the 12 period MAE, EMA, yes. The result of that calculation is the MACD line, yes. A 9-day EMA of the MACD, called the signal line, is then plotted on top of the MACD line. It can function as a trigger for buy and sell signals. Yes, I know that this is complicated. Yes, but this is the reason where when I speak about this at the end, because if you want and require to know more about this, it's necessary to study a lot of literature. Yes, so it's the reason why I show to you only this short presentation about these issues. Yes, traders may buy the stock when the MACD, moving average convergence divergence, crosses about its signal line, and sell when the MACD crosses below the signal line. Yes, you can study this slide, yes, at home more times, and if you need and require, you can find in the literature a little bit more information. Yes. So we'll continue with the definition. MACD equal to 12 period EMA. Yes, 12 period EMA minus 26 period EMA. Yes, EMA is a type of moving average that places a greater weight and significance on the most recent data points. Yes, MACD is often displayed with a histogram. You know what is a histogram? Yes, we draw a lot of histograms. Yes, with frequencies. MACD is often displayed with a histogram which illustrates the distance between the MACD and its signal line, in this case 9-day EMA. Yes. If the MACD, yes, moving average convergence divergence, is above the signal line, yes, which is presented here, yes, also in this illustration chart. Yes, signal line is orange curve. Yes, if the MACD is above the signal line, which is calculated like 9-day moving average. Yes, for the situation, 9-day moving average, the histogram will be above the MACD's baseline. Yes, above histogram. Do you know what is a histogram? Yes, remember we created a histogram for frequencies. Yes, So the histogram will be above the MACD's baseline. If the MACD is below its signal line, again, recapitulation, signal line, 9-day moving average, here in this illustration chart is orange curve. So if this is below, histogram will be below the MACD's baseline. Yes. The MACD has a positive value, yes, plus positive value, whenever the 12 period EMA is above the 26 period EMA, yes, and has a negative value when the 12 period EMA is below the 26 period EMA, yes. Okay, so at home, please read carefully this slide and also try to study this illustration chart, yes, where you can see here again the development of open, close, high and low prices, yes, and when I already say 9-day moving average, the signal line, the orange one, yes, MACD, and the histogram, yes, for illustration of this, what is present on this slide, yes. We will continue. We'll continue with Bollinger Bands, yes, Bollinger Bands. A Bollinger Band is a technical analysis tool defined by a set of trend lines plotted to standard deviations. Trend lines plotted to standard deviations, yes, positively and negatively, away from a simple moving average, yes, of a stock's price, but it can be adjusted to user preferences, yes. So there is some rule, yes, how to do this, but there is a space for the user modification, yes. There are three lines. There are three lines that compose Bollinger Bands. A simple moving average, yes, the middle band. The simple moving average is in the middle, and upper and lower band, yes. The upper and lower bands are typically two standard deviations, plus minus, from a 20-day simple moving average, yes. Two standard deviations. There is no quantile, yes. Do you remember when we calculated the forecasts? Yes, when we established a model, yes, a statistical model, ARMA or ARIMA entitled model, and we try to calculate forecast, we have a baseline of the forecast, yes, the middle value of the forecast, and when we require to calculate the bounds, the lower bound and upper bound, yes, we use, for example, quantile 97.5% quantile of the standard normal distribution, yes, because we required to fulfill all statistical, all diagnostical tests, yes, etc. So we use the quantile, and now we are not using a quantile, we are using two standard deviations as the measure of absolute variability, because you know that standard deviation is measured in the basic units, yes. If we model the prices, for example in dollars or euros, yes, the standard deviation is measured in dollars or euros, yes. So 2 times standard deviation, yes. Okay. the closer the prices move to the upper band, the more overbought the market. Yes. So one more time. The closer the prices move to the upper band, the more overbought the market. The closer the prices move to the lower band, yes, the closer the prices move to lower band, the more oversold the market, yes. So overbought and oversold, yes, two important things, yes. John Bollinger has a set of 22 rules to follow when using the bands as a trading system, yes. And again, you have here illustration. You have here illustration where we have here again open, close prices, maximum, minimum, yes. The chart, the special chart, yes, with this red and green symbols, yes. And there is a middle line. The middle line, if you remember, a trend line, yes, where we have here simple moving average, yes, the middle band, yes, simple moving average, the middle band in the middle, the red curve, yes, and 2 times standard deviation is upper and lower bound, yes, here in case of the Bollinger Bands, yes. So you can study this at home more carefully, yes, from the presentation, from this slide. And something about trading signals, yes, trading signals. So we have here x in time t minus 1, the previous value, yes, the previous value x in time t minus 1 is smaller than Bollinger band in time t minus 1, yes, and observation, the value x in time t is higher or equal to Bollinger Band in time t, yes, there is a signal for buy, but I forgot, yes, I forgot very important letter is L, yes, this means lower, yes, Bollinger bound in time t minus 1 lower, so if x in time t minus 1 is smaller then Bollinger bound in time t minus 1 lower, and x in time t is higher or equal to Bollinger bound in time t lower, that is a signal for buy. And x in time t minus 1, the previous value, yes, is higher than Bollinger bound lower, yes, Bollinger bound lower in time t minus 1, and x in time t, so current observation, is smaller or equal to Bollinger bound lower in time t. This is the signal for sell, yes, so you have here 2 signals, signal for buy, signal for sell, yes. xt represents the close price or another typical price, as we talked about lower, upper or open prices, close prices, minimum, maximum, yes. So typical price, such as the simple average of high and low and close price of the day, yes. Okay. OHLC graph. You already seen this graph on the whiteboard, yes, on the presentation, because we already see this graph that illustrates intraday changes in prices Open prices, high prices, low prices, close prices, yes? 4 columns. If you remember, when I show to you the data, yeah, the data sets for our modeling, we have 4 columns, yes? 4 columns, the date, yes, and 4 other columns with the prices, yes? In dollars, in euros, thousands of dollars, thousands of euros, etc. But prices, yes? The chart shows increasing or decreasing momentum, yes? When open and close are far apart, it shows strong momentum, yes? When open and close are far apart, it shows strong momentum. When open and close are close together, it shows indecision or weak momentum. Indecision or weak momentum, yes? The high and low shows the full price range, yes, of the period. That is useful in assessing volatility, yes? It's very important, yes, to check also the high and low prices, the higher and lower prices because of volatility, yes, and the danger, yes, of this price, yes, because if the volatility, the variance is high, yes, there is a danger, yes, for buying, selling, etc. Yes, some uncertainty. Yes. Okay. There is an illustration. Yes, another illustration of OHLC graph. Yes, where is presented as open prices, close prices, higher and lower. Yes, it's an option for illustration of this chart. Yes, or if I return back, yes, there you can see the barrels. Yes, illustrated in another way. Yes, okay. So OHLC graph. Okay, so today our seminar was based on a lot of theory. Yes, we talked about some moving averages, about the Bollinger Bands, yes, lower upper bands, about the chart. And everything was only, yes, in the theoretical framework. I think that it will be good that, for example, on the previous, on the future seminar, yes, I will show to you the OHLC chart, yes, the chart, the prices, because we downloaded. We already downloaded some data set, yes, for example from Yahoo Finance, yes, where we have these prices, open, close, higher, lower, yes, and construct in some software, for example, Excel, yes, Microsoft Excel is a very simple tool, but Microsoft Excel knows, yes, is able to create this chart, yes? So for example, on the basis of the prices, downloaded prices from Yahoo Finance, the next seminar we will construct this chart and we will continue about speaking in this theoretical framework, yes? These seminars, seminar number 11, and seminar number 12, yes, are not supplement for your other 10 seminars, yes? But it's important to note, yes, that all important things, all required things, yes, for the preparation of your paper, of your semestral thesis, and for your final presentation in front of me, yes, yes, you know everything. So please work, study hard the previous seminars, do your semestral thesis, yes, and be prepared for the 13th seminar, yes? Okay, so I think that in the theoretical framework this is enough, yes, and this is enough for today. I will see you one more time next week on the seminar number 12, yes, where we also continue in the theoretical framework, yes, with the technical analysis, yes. So this is the end of today's 11th seminar. I hope that you are already working on your semestral thesis, and next week I will see you like a teacher for the last time, yes. In the 13th seminar I will see you not like a teacher but like evaluator, because I will evaluate your paper and your presentation. So that's all for today. I hope that everything was clear. You have available my presentation, and that's all. So have a nice rest of the day, and bye bye.